This is Street Signals, a weekly conversation about markets and macro, brought to you by State Street Markets. I'm your host, Tim Graff, head of macro strategy for Europe. Each week, we talk about the latest insights from our award-winning research, as well as the current thinking from our strategists, traders, business leaders, clients, and other experts from financial markets. If you listen to us and like what you're hearing, please subscribe, leave us a good review, get in touch. It all helps us to improve what we offer. With that, here's what's on our minds this week. Hello, and welcome to the end of the year. As we've been doing the last couple of years on the podcast, we're devoting the last 3 episodes of 2025 to what to expect in 2026, and also how to use your time and capital towards ensuring that the new year is an enjoyable success. We start the cycle with our macro strategy team's year ahead piece, which covers the themes we think will be most likely to continue into and also emerge during the new year, with each of the members of the team contributing their insights. Last week, just before Thanksgiving, we published the written year ahead piece. That's on our Insights platform for those of you with access. And from that, we draw all of the content that you're about to hear, presented by each contributor with what they wanted to add to our team's view set. Now, for those of you who haven't read one of our year ahead pieces, or maybe missed last year's podcast version of it, we do the whole year ahead thing very differently. Instead of trying to come up with a consensus view derived from the thoughts of 12 or 13 very intelligent, very opinionated, very well-read individuals, instead, we ask each team member to independently write up a single trade idea that they think will outperform in the coming 12 months. We have no idea what each other are thinking, and the mix of ideas is always a great exercise to see where consensus risks are, but especially where points of difference emerge. We're not, or at least I'm not, big believers that anything changes just because the calendar turns from December to January. Markets can and usually do move in multi-year trends. So the first set of views you'll hear are ideas that worked pretty well this year, which we expect to continue working well into the new year. And this segues nicely into a block of ideas that are all about Japan. It's been decades since Japanese markets have gotten as much interest as they have recently, and they've clearly caught our eyes where themes for next year are concerned. The final block of ideas is dominated by contrarian thinking, or at least some new ideas. Here you'll find thoughts that might go against prevailing wisdom, or at least get you thinking about how to structure strategies in FX in unique ways. But let's start with the if it ain't broke, don't fix it views. Dan Gerard kicks us off.
My idea is another year of long semiconductors. Tech, especially semiconductors, has been the story for the past few years. After the stellar performance of 2023 and 2024, Q1 fears gave investors pause that maybe the run was over. It wasn't. And even now, we're still in the middle innings of this trade. Semis may be valuation rich for sure, but valuation is rich everywhere. The difference for semis is that revenue growth is both strong and consistently underestimated. Unlike the internet stocks of decades ago, semis, which has traditionally been a cyclical industry, has actually maintained strong and stable sales and earnings growth. Free cash flow yield may be low, but that's due to investment in the future, and the investment is self-funded. Revenue has been consistently underestimated by analysts, yet even using their estimates, the already low levels of leverage are projected to be negative by next quarter, Q1 26, as cash flow surpasses debt, and that insulates it from rate uncertainty. Current sales are funding the development of the next product, and more importantly, the projection continues to be that these new products garner a higher margin. Rather than being a late innings play, the semis group is preparing for customer demand to accelerate as every other industry adopts to the AI age. Whether it be advanced logic, high bandwidth memory, processing tech, or fabs, semis CapEx is the key to future growth in every other industry. So is it all in the price? Not likely. It's remarkable that there is consistent underestimation of revenue and earnings when the semis industry is the home of the most watched and channel-checked companies in the world. The resolution of China trade barriers would be a massive boost to marginal demand. It's expensive on a trailing basis, but the future is still likely underappreciated. Our holdings and flows data shows that even with investors being overweight, selling bouts have been rare. Strong earnings and strong margins are head and shoulders above the rest, and that should keep investors in the game for many, many quarters to come.
Now, if you know Maria Vateman, our head of equity strategy, you probably have a good idea of what's coming next. Or do you? This year, she has a slight wrinkle on her long-standing bullish views on U.S. stocks and U.S. tech.
My name is Maria Veitmane, and I'm going to talk about why investors have to stick with growth stocks over value. Once again, for me, the key reason growth stocks outperformed value for many years was scarcity of economic and earnings growth. For nearly a decade, with only a brief interruption around COVID, earnings growth globally was really subpar overall and outright poor outside a small group of mainly technology stocks. Investors, having seen those divergent fundamentals, favored growthier stocks for their strong and more reliable earnings, but also higher margin and exceptionally strong cash flow, all extremely important factors in time of uncertain economic and earnings growth. However, this multi-year outperformance of growth stocks, of course, has pushed the valuation and positioning risks to extreme. Indeed, our data shows that current holdings in growth stocks relative to value are at 25-year highs. Does that mean that finally, value stocks are likely to outperform growth in 2026? Absolutely not, unless we see better earnings growth for them or a major slowdown in earnings of the growth counterparts. Is this likely? It can happen in like two economic scenarios. Value earnings can accelerate if economy is doing better and we see better growth everywhere. Cheaper cyclicals like materials or small caps or emerging markets would do much better. Or the other scenario would be if we go into recessions and growth slows, rates are cut, and once we start coming out of the slump, all kind of value stocks will rally. Unfortunately, those two scenarios are really tail risk at the moment, and far more likely we'll see economy bumping along, earnings growth continue to concentrate in small groups of already expensive companies, and this will once again widen the gap between growth and value stocks.
Now, putting U.S. curve steepeners on last year worked pretty well despite huge negative carry and roll down. But you had to get your timing exactly right. You probably had to get out by April. This year, Kayla Sater thinks the cost will still be worth it.
My 2026 trade idea is a 2s10 steepener, but not just any steepener. Next year, I'm expecting front end yields will fall and long end yields will rise. So, kind of like a mullet trade, if you will. So, what would send front end yields lower? The first is monetary policy. The Fed is expected to continue to ease at least back to neutral. So, this should send front end yields lower. Secondly, when I look at auction demand has been stronger at the front end of the curve than at the long end. So I'm thinking of things like bid to cover ratios and variables like that. So what would send the long end higher? Ultimately, I think there are multiple drivers that should send term premia higher. One of these reasons is uncertainty. So right now, uncertainty continues to be well above average. However, term premium is below average, and usually those two variables have a really strong correlation. So the fact that there's a bit of a mismatch here tells me that there could be an opportunity for pricing to adjust. Looking towards next year, if we see variables like a growing deficit, uncertainty around tariffs, federal policy implementation questions, stagflation risk, there's a lot of drivers of uncertainty out there and anticipate term premium to rise. Secondly, the buyer base for 10-year treasuries has shifted to a more price-sensitive buyer. As foreign demand for 10-year treasuries has declined, investment funds have stepped in to fill the gap. This group tends to be more price sensitive and requires greater risk compensation. And so with that, I give you a mullet steepener trade for 2026.
It was also an excellent year for EM FX carry trades, but consensus risks in the currencies are growing. Dweivor and Carlin from our EM team each independently suggested the better opportunity is now in local EM rates markets, though Dweivor does still like the currency exposure in his trade.
Hello, this is Dweivor in Hong Kong, and my idea for the year ahead is to receive long-end Brazilian bonds, and it actually follows on from a long Brazilian real idea that I had for 2025. The Brazilian Central Bank led the way in late 2024 to tighten policy on the back of an inflation spike. The cycle has turned, and relative to the central bank's 1.5% to 4.5% target inflation range, the most recent 12-month inflation expectations in Brazil have fallen to the lowest level in a year. Nominal rates in Brazil, real rates at this point, are extremely sort of high. Price stats indicates inflation at around 4.5%. It's the weakest in nearly a year. But even with low inflation expectations, even with low price stats inflation and high nominal rates, the BCB in Brazil is pursuing a very cautious line on interest rates. And that's underpinned its policy credibility in recent years. So this is supportive for receiving Brazil 10-year local currency denominated rates. And for Brazilian real assets in general, the US has recently reduced tariffs on certain Brazilian foodstuffs. It eases trade tensions. It supports Brazil's external position. And meanwhile, the gradual economic deceleration that we're seeing in Brazil as well, PMIs have trended lower for most of this year. The 2025 GDP forecast has been cut, should take local rates tighter, potentially reinforced, of course, by the disinflationary impact of currency strength. And indeed, high real rates at 10% are also supportive of the real, in effect, putting a virtuous circle in place of higher rates, currency strength, and a disinflationary pass-through. Now, the risks around this, they basically center on two factors. One is political noise. We do have a presidential election in October next year, but that's some way away. And also the fiscal backdrop remains fragile. Speculation around increased social spending, adding to investor caution over recent months. But these budgetary concerns have been a potential headwind for at least a year in Brazil, and by now are largely encompassed by the central bank's tight monetary policy stance. So for us, this opened up another potentially strong year ahead for Brazilian assets, and in particular, Brazilian rates.
SAGBs will start 2026 in pole position, having just received a credit ratings upgrade. In addition to better than expected fiscal performance, the SARB's competence as an impressive inflation targeter augurs well for the local bond market. In addition, real interest rates are positive, and there is still some headroom for further monetary policy easing going forward. Inflation, meanwhile, remains subdued, and the formal shift to a 3% target comes at a good time. The fortunes of government finances may not stay good forever. Most of the extra revenues have been generated by rising mineral exports and higher gold prices. However, the SARB's institutional reputation means that the standing of SAGBs is in good hands. Now, this trade is better currency hedged. Why? Well, the rand remains a proxy for global risks, be that tariffs, the global cycle, or China. Moreover, investor behavior has been excessively hedging activity of SAGBs ever since Trump took office, with no letup. The underlying bond story is fantastic, and hedging the associated FX risk should mitigate against the ongoing global turmoil.
A final trade that worked really well this year, which also works very well as a segue into our views on Japan, is Benluck's belief that it'll be another great year for Japanese stocks.
My year ahead trade is to simply go all in Japanese equities. While it's still early days to assess what Prime Minister Takaishi can deliver with respect to fiscal stimulus, it is important to highlight that current Japanese macroeconomic conditions remain robust. Consumer confidence is climbing, inflation expectations are rising, and economic surprises have actually been positive. Historically, these factors have led to a stronger yen, reflecting the country's a solid economic foundation. But it's also important to highlight that a stronger yen does not automatically translate to underperformance in Japanese equities. In fact, while yen weakness has previously attracted foreign investments, this time real money equity holdings have actually remained unchanged over the past 1, 3, or even 5 years. Instead, investors have been closing their underweights in Asia and Europe and reducing their overweights in the US. Despite this lack of real money participation, Japanese equities have actually gained 20% year to date. This performance is remarkable, but for Japan to actually achieve a sustainable outperformance, we do need to see both domestic and foreign investors return back to the market. During the Abenomics period from 2012 to 2014, we actually observed less foreign buying from Japanese investors, when optimism in domestic economy was high, driven by aggressive fiscal stimulus. The new government in 2026 is expected to introduce more public spending, refundable tax credits, and initiatives to encourage domestic investment. We recognize that political and economic uncertainties will remain elevated, but this has not led to excessive bearishness towards risky assets. If we anticipate a similar modest backdrop in 2026 with relatively low tail risk, Japan could actually be one of the strongest equity markets over the next 12 months, even outperforming the US, Europe, and even emerging markets.
Ben just noted that Japanese yen strength is not necessarily an impediment to further strength in Japanese equity market returns. So we now come to two long yen ideas from Lee Farage and then Fred Goodwin, which take this theme further.
But my year ahead trade is short sterling yen. I know long yen has been the widowmaker for many a year ahead piece over the last few years, but this is my first foray into the long yen camp. Why now? Bottom line, I think the inflation that we've seen in Japan over the last 18 months is real and is here to stay. It's driven by wages, and wages are driven by the tight labor market with a very low unemployment rate. The difference now is demand for labor in Japan is from the service sector. Service sector jobs are much harder to move overseas than those from the manufacturing sector. And that's why the labor market will stay tight, given a decline in population. That means stubborn wages. That means stubborn inflation. The market is pricing barely anything in terms of BOJ hikes coming forward. 2-year implied rates are at 1.4%, just 90 basis points of hikes over the next 2 years. Japan has the most negative real rates in the G10, and there is significant fiscal stimulus on the way. Contrast this with the UK, where growth is comparable to Japan, and there's fiscal tightening on the way. In the UK, though, implied rates in 2 years are 3.5%. So just 100 basis points of cuts from here and 200 basis points above those of Japan. Finally, valuation. I know the yen has been undervalued forever, but at some point that has to matter. Using price stats and looking through the legs of dollar yen and cable from price stats, which you can't strictly do, but it gives us an approximation of the level of undervaluation. And that comes out at around 30%. That has to start to matter. So relative rate pricing and valuation, those two things together push me into short sterling yen as my year ahead trade.
Mr. Riss' idea can be summed up in the following way: a broken record. This will be the third year in a row that this strategist has recommended a short dollar yen. The arguments are as follows. First, there is a cheap valuation. The yen is 40.7% below its 20-year average, by far the most negative deviation of all the G10 currencies. Second, CPI is 2.9%, which strongly argues for the BOJ to lift rate. Currently, the BOJ is expected to increase rates by 53 basis points over the next year, and a time when most other central banks are expected to cut rates. Perhaps the best argument for owning yen is the traditional safe haven quality that stems from its net international investment position of 65% of GDP. When stuff hits the fan, Japan repatriates capital. A forward-looking indicator for the VIX points higher, a bullish factor for the yen. The final factor arguing for a strong yen is the 98-month cycle for the real Japanese yen that goes back to the late 1970s. It bottomed out more than 2 years ago and is pointing higher. Could this be the year the dollar yen plunges 30%?
My own idea is in many ways correlated to some of the thoughts in Ben, Lee, and Fred's ideas, in that I think the steepening of the JGB curve this year is just about done, and that we'll see flatter curves in the new year. My view is also a contrarian take on the doom and gloom that you read right now about Japan's debt pile. Japan does have a lot of debt, but its debt dynamics are significantly improved since the pandemic. What people don't get is that Japan is growing at a much higher nominal rate than its cost of funding. Basic debt sustainability math says if that's the case, and you aren't running enormous primary deficits, you really don't have a debt problem. In fact, Japan's net debt to GDP has fallen by 30 percentage points over the last 5 years. So the fiscal stimulus introduced recently by Prime Minister Takaichi is 3% of GDP, she's not exactly breaking the bank here, especially since the MOF have shifted issuance towards the front end of the curve where yields are still a lot lower. And unlike the Abenomics period 12 years ago, the Bank of Japan is not going to sit idly by and let inflation rise, not when headline and core inflation are still above target at 3%. Demand patterns really are why long-end yields in Japan have risen so much this year. The BOJ isn't buying as many, and pensions no longer need ultra-long duration as much as they did to match against liabilities given we're in a higher rate environment. But yields are now at levels that domestic investors are going to find really difficult to ignore. Especially when you look at yields on offer overseas, they're not that appealing after you account for FX hedging costs. And we know from Lee and Fred's ideas that the yen is attractively valued. It makes sense for domestic investors to start participating in the long end of their domestic bond market a lot more. So flatter curves should be the result. I do like outright received positions in the long end of Japan, but that's a really risky call to make, looking for that top end yields. So it's a 10s 30s flattener for me this year. It's not going to be a home run, does have a small amount of negative carry and roll down, but if anything I've said so far comes good, it should earn back multiples of that. Moving on, we have a few final ideas that aren't easily categorized or are maybe somewhat contrarian in nature. We start with Noel Dixon, who's looking for some of this year's weakness in the US dollar to reverse.
My year ahead trade is to go short euro dollar. The euro is one of the best performing G10 currencies year to date, up 14% from a total returns perspective. Much of the euro dollar gain was shaped by policy uncertainty coming from the US. The idea of American exceptionalism came under scrutiny when the Trump administration introduced a trade policy on Liberation Day that disrupted the global trading order. This uncertainty weighed on the US dollar as investors began exploring other places to put their money. Since then, however, the Trump administration has struck several trade deals, restoring clarity and reassuring markets that global trade would remain intact. As a result, investors will likely revert back to fundamental differences between the US and Europe, and I believe it will become clear that euro-dollar is misaligned with current realities and therefore its current pricing. For starters, the Eurozone still has major structural issues, including a productivity gap, elevated energy costs, and slow progress in digital adoption compared to the US. The U.S. is set for increased spending in the first half of 2026 as upfront stimulus from the One Big Beautiful Bill takes effect. Measures such as the full bonus depreciation, infrastructure and defense spending, enhanced tax benefits to the consumer will add about 70 basis points to GDP in 2026. Meanwhile, fiscal efforts in the Eurozone will only add about 30 basis points. Higher growth trends in the U.S. warrant higher interest rates, thus giving the dollar the higher rate advantage. Political risks in the Eurozone continue to linger, specifically in France. Discourse over the public debt, which currently exceeds the EU's 3% limit, will likely persist into next year. So we cannot rule out the possibility of a snap election in France, which is not good for the Eurozone. At this point, Euro is the second largest overweight positioning among the G10 with real money investors. Altogether, euro-dollar seems like an obvious short for 2026.
Since the pandemic, we've done a lot of work using machine learning tools for currency selection. It gives us a good sense of what themes are driving FX returns. So Michael Metcalf has some thoughts on following FX styles next year.
So 12 months is a long time to put your faith in one asset or currency pair. Things can change a lot of that time period. So this year, I decided to pick an FX factor, and specifically one that selects currencies on the basis of relative growth differentials as captured by relative equity market performance on a rolling 12-month basis. There are three reasons why I think this will be the go-to strategy for 2026. First off, 2025 was a year of policy uncertainty, so I think 2026 will be the year when we see the impact of that policy leading to potential changes in relative growth expectations. And also there are crowds in several equity markets that might unravel. Secondly, going into 26, our holdings metrics suggest that investors are currently underweight this strategy, even more so than carry. And that typically improves the risk reward in the following 12 months of what is one of the most attractive FX factors to follow. And then the final reason is that following equity differentials is often the go-to strategy of the machines in our Mind and Machine publication. And that's something we're going to look to integrate even more fully into our view set next year. So they're the three reasons for expecting equity differentials to drive currencies in 2026.
Our final trade has potential to be the most contrarian of all, in that if it really works, a lot of the first few ideas that continue this year's themes will probably struggle. That's not necessarily the intention or motivation for the trade, though, so I'm going to let its owner, Marvin Loh, have the final word.
My year ahead trade idea is to expect wider corporate IG spreads. Like most risk assets, corporates have had quite a run in 2025, although we think that IG in particular is amongst the richest within the fixed income asset class. But rather than just point out an expensive asset class, we think IG in particular is going to be challenged in 2026 from issuance, growing concentration risk, and liquidity. On the issuance front, we're likely to see a near record amount of debt sold this year. Most recently, it's been the hyperscalers that have been leading that charge. But that's also created concentration risk, as tech is now about 9.5% of the broader index. We'd note that data center funding is only expected to accelerate and will contribute an additional $1.5 to $2 trillion in issuance into the end of the decade from the investment grade space. And while record order books for some of these large tech companies shows that there's no lack of demand, there is a growing concern with AI concentration across asset classes, which includes equities, bank exposure, as well as fixed income. Bonds, however, don't offer the structural upside of stocks, so it's natural to shed IG exposure in an attempt to reduce that index-driven concentration risk. And finally, we'd point out that scarcity liquidity dynamics should apply upward spread pressure. This is mainly going to come from the Fed's balance sheet normalization process. And while the Fed's ending of QT in 2026 should relieve liquidity pressure, we think that the Fed is keen to reduce its MBS exposure to zero, which will potentially pull that corporate tourist back into the MBS space, creating demand dynamic concerns at a time when supply is increasing. Where does this leave us? We think that spreads could easily get to 100 basis points above treasuries and would actually expect and target 120 basis points above treasuries by the end of the year. In terms of downside, given how tight the market is, as well as economic concerns and increasing defaults, we don't necessarily think that we're going to see much tighter spreads than where we are now. So thank you for listening to my idea, and have a great 2026.
There you have it, a dozen ideas that hopefully give you a sense of the strongest core views from our team for the next year. We aren't quite done with the podcast this year, though. In fact, the fun's just getting started. Next week, we'll have some thoughts from the trading desk at State Street, looking back and looking forward. And we'll finish the year, as we always do, with the strategy team's book and media recommendations. That is always a favorite one of ours, so don't miss it. Thanks for listening to Street Signals. Clients can find this podcast and all of our research at our web portal, Insights. There, you'll be able to find all of our latest thinking on markets, where we leverage our deep experience in research on investor behavior, inflation, media sentiment, and risk, all of which goes into building an award-winning strategy product. And again, if you like what you've heard, please subscribe wherever you get your podcasts and leave us a review. We'll see you next time.